Episode 3, and we're talking about the silver price phenomenon that's confusing people, pissing people off, and exposing how broken price discovery really is. Right now, there are two silvers. One silver trades in the United States like a paper instrument, the other trades in China like a strategic physical asset. And that's why the price looks like it's tearing itself apart. As of January 31st, 2026, COMEX silver futures in the United States were trading around $85 per ounce, according to CME Group. At the same time, on the Shanghai Gold Exchange, the AG T plus D contract closed at roughly 27,530 yuan per kilogram. Slow that down. Converted using the prevailing US dollar to yuan exchange rate and converted from kilograms to troy ounces, that Shanghai price works out to roughly $123 per ounce. That's a gap of almost $38. That is not noise. That is not a rounding error. That is a signal. Silver matters because it sits at the intersection of money, industry, and geopolitics. It's a monetary metal. It's an industrial input. And when supply gets tight or political, it becomes a strategic resource. When prices fracture like this across regions, it means paper markets and physical markets are no longer speaking the same language. In late January, silver went through a violent reset. According to Reuters and Barron's reporting, silver futures sold off sharply after sudden shifts in U.S. macro expectations and speculation around Federal Reserve leadership. Then the exchange stepped in. On January 31st, CME Group raised margin requirements for silver after extreme volatility. That's not a conspiracy. That's the plumbing saying leverage got too hot. Here's what actually happened. Silver ripped higher as speculative and macro money piled in. Then forced liquidation hit the U.S. futures market. Paper silver collapsed. Physical linked pricing in China did not follow. And that divergence is the story. The US price and the China price are different because these markets are pricing different realities. China prices silver closer to physical necessity. Shanghai pricing reflects what it actually costs to secure metal in country, in size, on time, and under regulatory constraints. That includes delivery limits, inventory financing, and availability. U.S. pricing is dominated by paper flow. COMEX is driven by futures leverage, margin mechanics, algorithms, ETFs, and liquidation cascades. Paper can move instantly, metal cannot. And arbitrage is not frictionless. You cannot just buy silver in New York and magically deliver it into China. Moving physical metal requires sourcing, shipping, insurance, assaying, compliance, and time. Those frictions allow price gaps like this to persist. Now, let's be clear about paper silver versus bullion. Paper silver is exposure. It's leverage. It's a bet. You can control massive notional silver with a relatively small amount of capital, which means price can move violently without a single bar changing hands. Silver bullion has to exist. It has to be refined, financed, stored, insured, and delivered. Bullion pricing includes fabrication premiums, delivery premiums, and availability premiums. So when someone says silver is $85, the correct question is simple. Which silver? A futures contract or real metal delivered now? Most media coverage misses this completely. They say silver moved because investors got scared or because the dollar moved. That's a headline, not a cause. The real driver is market structure. Paper markets clear instantly. Physical markets clear slowly. When physical supply tightens or becomes strategic, the basis blows out. And when margins rise, weak hands are forced out. That's not bullish or bearish. That's position clearing. Here's what I'm watching next. If Shanghai pricing stays materially above US pricing, the physical signal remains intact. If that premium collapses, something in supply, demand, or policy changed. Higher margins will continue to reduce leverage and thin participation. And macro policy risk is still live. U.S. monetary expectations just proved they can detonate silver positioning in hours. Now here's the hard take. The U.S. price is a paper clearing price. The China price is increasingly a physical availability price. The gap does not mean silver is fake. It means silver is being priced through two different systems, one built on leverage, one built on supply. And remember this, when an industrial superpower pays up for physical metal while the West trades paper contracts, the story isn't the candle, it's the plumbing. If you want real commodity intel, subscribe, and don't forget the alarm bell, you bitch.